Gold stocks have been surging lately, but the broader materials sector has lagged the market pretty badly. How do you sift through the 1,600 plus materials and gold stocks to find the very best for your portfolio? In this video, I'll show you what to look for in the sector, how to find the companies with a competitive advantage, and how to pick the best stocks. In fact, I've found 5 stocks to buy now that could produce returns of 25, 30% and more in 2020. We're talking materials sector investing today on Let's Talk Money.
Beat debt.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's Talk Money.
Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. A special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now Nation, we are 9 videos into our stock sector series and I'm loving it. We've already seen returns as high as 9.2% on Energy Transfer and 4.5% in Microsoft, and that's just in the last couple of weeks. In this video, we're getting into a sector that could have a big year in 2020 on one specific industry, that's gold. The price of gold is up 20% over the last year, but that's helped the gold mining stocks surge over 42%, nearly 3 times the 15% return on the stock market over that period. But the materials sector is so much more than just gold stocks, and I think some of these other industries could be ready to run as well. In this video, I'm going to show you how to look at this material stocks, how to find the best of breed in each industry, and reveal my 5 favorite picks for 2020. It's all part of our 11 video series uncovering the best companies in each stock sector of the economy. Over these 11 episodes for each stock sector, I'll show you how to pick the best of breed in each. We'll look at some of the big trends and how to pick those stocks to buy. Then I'm going to reveal my 5 favorite stocks in each. If you're coming in later to the series, I'll link in the first comment below to the most recent video. I'll also be linking in the video description all the videos in the series so you can see all the stocks for each sector. Now looking at the materials sector, we see industries in mining, metal refining, chemicals, and forestry. Basically think of any industry that takes something out of the ground or produces a chemical, except for what we saw in the energy sector. The sector has lagged the market quite a bit over the last 5 years. In fact, only the energy sector has performed worse here with a 32% loss against that 16% gain on the stocks in the materials sector. But these stocks are now in value territory and prices for some of these materials are starting to rebound. Gold has surged in the last year and provides one of the best safety nets against a stock market crash. So 2020 could be the perfect time to start loading up on these stocks. On a price to earnings basis, the sector as a whole doesn't look cheap or expensive. Here we see the materials sector in the middle at a 17.2 times PE ratio. That's right at the value on the S&P 500 market index. If we look at the 10-year average PE ratio for the sector at 14.6 times, we see the sector is trading at nearly 18% more expensive than that long-term value. Now that's not as bad as the premium on some of the sectors that we've seen in the series, sectors like tech stocks or utilities, but it's not as cheap as those financials, energy, or healthcare either. While the sector might be a little expensive right now, there are still some individual stocks that you can get a great deal for. Now, like we've done in the previous videos, I want to highlight a couple of materials sector ETFs that you might want to consider for a broader exposure. Then I'm going to reveal those 5 materials and gold stocks that I like. Think about these if you can't find stocks that you like, but you still want that sector investment, or if you just want a little bit more in one part of the sector. The Materials Select Sector SPDR ETF, ticker XLB, is the largest fund in the sector with shares of 44 companies averaging $44 billion in market cap each. The fund pays a 2% dividend yield and gives you exposure to these 4 industries in the sector, though it's a little lopsided with 72% of those assets in the chemical space. Now the fund has produced a 13% return over the last year, but if you do decide to buy this, you might also want some individual stocks in the mining and construction industries just to round out your exposure. For a general investment in gold stocks, I like the Vanck Vectors Gold Miner ETF here, ticker GDX. It's going to give you an investment in 46 gold mining stocks with a global range of companies. You can really see the strength in gold stocks here in this chart on returns with that larger materials sector fund in red versus the gold miners GDX. Investing in gold stocks has been a much more volatile bet though, with a 46% return over the last 5 years, hiding those big ups and downs. Looking at individual stocks to buy here, you really need to be on top of the specific industry for these. Screening for the best of breed in each industry, I used the same screen that we described in our first video on tech stocks, but I also had to look into the markets for each of these. And one of the most important things you can look at for these material sector stocks is supply capacity and the capacity growth for each industry. Now, growth and demand is usually fairly constant for these chemicals and industrial materials, so that big factor is going to be supply. What happens is this sector is one of the most cyclical in the market. Producers start seeing those prices rise for these materials, stock prices jump, and they just add crazy amounts of supply. They start adding factories or mines, or they'll hire for factories that weren't producing at their max capacity. Of course, that just leads to a boom in supply that isn't matched by demand, and prices come back down, which of course means that companies have to cut supply and share prices sink again. So when you're looking at these companies, use those fundamental factors that we've talked about in the other videos, factors like rising year-over-year sales and an operating margin above competitors. But you've also got to look at that supply-demand picture for these basic materials that they're selling. If you haven't watched that first video in the series on tech stocks, make sure you check that out because we detailed those fundamental factors that we're using. Freeport McMoran, ticker FCX, mines more copper than any other publicly traded company in the world and is my favorite gold stock right now. The price for copper has slumped to just $2.60 a pound from a 10-year average of $3.08 per pound, and it's really squeezing these higher cost producers out of production. Management expects a turnaround year for prices to start late 2020, and investors could start coming back to the shares sooner than that. Now, just on its current mines, FCX estimates replacement value at between $36 to $45 billion to reproduce those assets. That's above the $36 billion enterprise value, that market value plus the net debt, which essentially means management has estimated the company's worth up to 25% more than the market says it is. Analysts expect earnings to bottom out this year at just 2 cents per share before jumping 25-fold to 50 cents per share over the next 4 quarters. Even if management can come close to that, it would be a major turnaround and a confidence booster for this stock. Driving those expectations are some big project completions, like the Lone Star project in Arizona, which is more than 50% complete and scheduled to start producing late 2020. This Grasberg underground mine is now in the production phase, and most of the capital costs are behind it as well. Analysts see the shares at around $12 on the low end and as high as $14 per share over the next year, on top of that 1.8% dividend yield. Now, if you like Tesla, then you should love shares of Albemarle, ticker ALB, the world's largest lithium producer. Lithium is the powerhouse for electric vehicle batteries, so if you believe in that long-term push for electric, this is the stock to watch. The problem is lithium producers are paying for huge supply growth earlier in the decade. Annual supply is now 5% over demand, and the global average price has plunged 50% since late 2017. That's a pretty common story in mining and commodities, though. Miners always ramp up that production to oversupply levels when they get good prices, and then they get shocked when prices crash. It happens all the time, but if you can time it to get in around the bottom of that supply-demand curve, you can usually do really well on these types of stocks. The lower price is squeezing out a lot of the higher-cost lithium producers. ALB owns some of the lowest cost mines in Chile and only about $1 billion in net debt, so it's definitely got the financial power to survive as some of these other producers fall out of the picture. Shares trade for 11.2 times earnings, so profits are expected 8% lower over the next year as the market works through that excess lithium supply. Demand for battery quality lithium is expected to double through 2025, and ALB is expanding capacity from 65,000 tons last year to 155,000 tons by the end of 2021 to meet that demand. If demand keeps increasing as expected, it could very quickly turn profits higher through the next few years. Analysts are torn on this stock, with a low estimate of $41 a share to a high at $109 for the widest range that we'll see on this list. This one could still be painful over the next year, but could also work out to be a great long-term buy. Coatings and plastics giant Dow, ticker DOW, makes the list with its 5.2% dividend yield and what could be a turnaround 2020 story. The sales picture for Dow and just the broader plastics group hasn't been good. Revenue fell across every segment over the last year, but it looks like 2020 might bring a rebound. The company is in a major restructuring and a cost savings push that had cut over $1.36 billion already. Most of its 2020 and 2021 debt is paid off, so there's a lot of financial flexibility here. Shares trade for 15 times earnings, with profit expected 8% higher over the next year. Earnings are still tough to predict here after Dow split from Dow DuPont earlier in the year. The company beat expectations by 24% last quarter. Analysts have the stock at a target of $48 a share at the low end and a high around $65 a share over the next year. It's a solid dividend yield, and I think a good opportunity to grab this one before that business environment improves and brings other investors back into the stock. The pain across the heartland in farming has hit CF Industries this year, but this is another one that could see some strength over the next couple of years. CF is the largest nitrogen fertilizer producer in North America and just critical to corn growers since the plant doesn't produce its own nitrogen like soybeans do. That's probably a little bit more than you ever wanted to know about corn, but from Iowa, so yeah. The trade war and other factors led farmers to plant the fewest corn acres in a decade last year, but they've also been using more fertilizer to get the highest yield possible. That meant product volume was flat for CF, and cost cutting helped drive a 17% improvement in the earnings over the last year. Shares trade for 21 times earnings, which is a little pricey, but profits are expected 14% higher over those next 4 quarters. Planted acres should improve, especially on any kind of a trade deal with China, and the company is already benefiting from those low natural gas prices right now, which account for 50% of its material cost. China is exporting a lot of nitrogen to the U.S., which could still weigh on fertilizer prices a little bit, but CF has the advantage in that lower local natural gas prices and its closeness to customers. Analysts see the shares around $44 each on the low end to a high of $62 per share over the next year, along on top of that 2.6% dividend yield. Now, this next one is a rare opportunity and a stock that always seems to be going up. $52 billion Ecolab, or ticker ECL. Ecolab is the leader in cleaning and sanitation products for the hospitality and healthcare industries. Revenue is twice the next largest competitor in a very fragmented market, so ECL controls about 11% of the global market here and some real power to consolidate more share. Now, what I like about the company, and you see this in some of our other stock picks in our sector series, is it's using that razor and blade business model. This is where it will give away or discount cleaning equipment to customers, but the equipment only runs on Ecolab products. So in effect, it's locking in customers into this cleaning solutions, which gives it a huge amount of pricing power and customer loyalty. Shares here trade for 32 times earnings, which seems extremely expensive until you look at that long-term chart of the stock. In fact, we're seeing a pretty rare dip in the share price this year compared to that long, steady climb higher. Now, I'm not sure that makes it worth a 32 times PE ratio. I really like the business model here, and the earnings are expected 12% higher over the next year. The company plans to spin off its upstream energy business, which includes oil-filled chemicals, in 2020. That could be a catalyst to send the shares higher and rationalize that kind of valuation. Now, analysts have targets on the shares at $184 on the low end to $210 a share on the high end, which would be right around the high that it reached this year. I'm following Warren Buffett into 5 bank stocks in the video on the right. Some of these are trading on huge discounts to their fair value and could produce strong double-digit returns. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.